Let's say you've got $1,000 balance on your credit card, and 400 of it is from purchases that you made for your business, and 600 is from new clothes.
What? Who, me?
Right? So I'm Steve.
I'm Riley.
Tax Force is our company. What's this segment called? The segment's called Teaching Riley.
So Steve, we were talking before about which debt and which loans you should be paying first, and you mentioned that sometimes it might depend if you have interest that's tax deductible.
Right.
So, for example, I just graduated, I'm working on paying my student loans. Is there anything for me there that's tax deductible? What should I be looking for?
Right. So student loans, there's many forms of student loans. You can get like a line of credit from the bank, but OSAP, loans that you get through the National Student Loan Center, absolutely, that, while not a tax deduction per se, forms what's called a non-refundable tax credit. We're not going to get into that in this video, but suffice to say that it does provide you with a lower tax bill, right?
Okay.
So it is a deduction for you as far as that goes.
Okay.
So you do have to log on annually as part of your tax process as you're gathering up your T-slips and such. Log on to the National Student Loan Center and get the interest statement from there. That's definitely very important. It's going to lower the amount of tax you pay.
Okay, awesome. So what if I'm investing? Is there anything I can do there for the interest on that?
Absolutely. So if you've invested in certain types of accounts, so not in your RSP account and not in your tax-free savings account, but if you have investments in your normal trading account and you've borrowed money to invest, right? Lots of times people will do that. They'll borrow either on margin, which means you borrow against stocks that you already own, or you might get a line of credit or a loan specifically to buy specific investments.
Okay.
The interest on that loan is tax deductible.
Okay. And then what about if you're a business owner?
Okay.
We have lots and lots of loans for business owners.
Business owners typically have lots of loans. So generally speaking, like before when we talked about what is tax deductible, what have I borrowed this money for? Is it helping me drive my business? So if it's a loan or a credit facility that's helping your business, the interest on that's probably tax deductible.
Okay.
Right. Things like, if you're a small business that operates out of your home, part of your mortgage, because of a home office, would be tax deductible.
Okay.
If you use your car in your business, part of the car loan would be tax deductible based on the amount that you drive the car for business.
Okay.
Right? If you've got an operating line to buy some material or supplies for your business, the interest on that operating line would be tax deductible.
Okay.
If you've got a credit card that you use for business, the interest on that could be tax deductible. But there are some caveats here, okay, and where it gets a little complicated, especially with lines of credit and credit cards, the government likes to see what they call a clean credit facility. And what that means is that if we're allowing you to write off the interest on this credit card, we need to make sure that all the payments, all the charges to this card are for business.
Yes.
Right?
Yeah, makes sense.
Because when the interest gets calculated at the end of the month, the government can come in and they say, well, is the interest being charged on the business or is it being charged on the person?
Gets complicated.
Right? There's no way to divide it up. And when you then go to the next month, you say, okay, well, let's say we pay off only $200 of that $1,000 balance.
Okay.
Well, did I pay off 200 of the business? Did I pay off 200 of the personal? Is it some sort of, is it 60-40 split? The first month we can actually probably figure something out that would be arguable. However, once you then go into the second month, it just becomes very, very complicated. And the government's go-to is if it's not clean, we just disallow it.
So just make sure you have separate credit cards and lines of credit for your business and for your personal expenses.
100%. It's so important. If you want to be able to write off the interest, you need to have a separate facility. And then so that leads to, if you've got 2 credit cards and you can't afford to pay off all of the balances on both, and they're both the same interest rate, pay off the personal one first because the interest on that's not tax deductible. Let the interest on the business one accrue, right? Pay that, and that because that's tax deductible.
Makes sense.
Right on.